In celebration of Halloween, Ryan and I discuss in this episode some frightening comments, some of them quite spooky. In doing so, we also talk about universal life, loans, loan balances, modified endowment contracts, and the like. We had fun doing it and hope you enjoy. Thank you for listening and happy Halloween. Welcome to the Banking with Life podcast. I'm your host, James Neathery.
I'm your co-host, Ryan Griggs.
And here we are on a Saturday morning, living large and having fun, making it look easy. But look, tomorrow's Halloween.
Yeah, happy Halloween. Happy however many days until the election. That's what I like about Halloween, is that it's close to the election being over.
Yeah, it's going to be scary. That's no question about that. It's going to be scary. Well, maybe we'll know the first quarter, after the Supreme Court goes through their selection process, we'll know who the president is.
Yeah.
I don't know. Actually, today is October 17th for us. So.
Yeah. And do you know all the while all that's going on, cash values are just going to be steadily rising?
24/7?
Yeah.
Even on Sundays?
Yeah.
Is the market even open on Sunday?
Depends on who you are.
Yeah, no question. All right, so listen, let's talk about something scary.
Comments.
Unreleased comments, okay?
Unreleased, yeah. The people who...
you see how quick he pulled that out? Yeah. Comments, and look, it's already redacted. So don't tell me you're not prepared, Mr. Griggs. Oh, wait, look. He redacted my copy as well.
Many of the comments are great, right? People are very supportive and interested and have very nice things to say and thank you and all that's very much appreciated. And it's the ones that are glaringly problematic that are, I don't even like that word, but they're the ones that... The annoying ones are the ones that pop out.
You can see past the comment, okay? And listen, this particular thread that has been printed out, it's been a interesting topic of discussion within the office. I mean, briefly, as we're going about our business daily. But the audio visual, the AB Ninja, it's come up a couple of times. This particular commenter, my comment on her comments is like, the lady's drunk. She needs to get off the channel. I mean, because it was like she ripped through about, I don't know, over a 3 or 4 day long weekend.
Yeah.
She posted, I don't know, 10, 12 comments, and they're just not going to be released. But maybe on the client only access, we'll go deeper into it. But I don't want to call anyone out, but I just want to share the comedic value from time to time in some of the comments, okay? Mm-hmm. I mean, you obviously get to see the ones that are released, and, listen, you can comment, just don't cuss, okay? Be polite, and don't promote yourself or your product or whatever it is you're doing looking for justification of what you're doing, So comments are really good, but, I mean, just be civil, right? Yeah. Anyway.
So some of the things we have in here... So this person says, if anybody is discussing IBC, they either understand or on the way of understanding. And maybe that could be the case. And by the way, nobody knows what exactly you guys mean by a well-designed policy. So James, why don't we tell people exactly the correct structure that everybody should build their contracts to the digit, to the 100th percentage point place on the show?
Listen, my clients, his clients know exactly how their policies are built, and they know exactly why they are built the way they're built. And they're built, it's akin to being handcrafted. I mean, as weird as that may sound, or, maybe that, however you hear that, everybody is different.
Yeah.
I mean, we all want the same basic needs, there's no question, but, your finances, your cash flows, your future goals and endeavors and current endeavors are different than mine. So what may be good for you, oh, wait a minute, and you're like 30 years my junior. Okay. And so we're supposed to have the same type of policy or the exact same structure? No. Well, fundamentally, what I have discovered practicing the infinite banking concept over the last 16 years, excuse me, making probably every mistake that you could make on me personally, on our policies personally, what I have discovered, all right, and it's not just like, oh, I found the secret. None of that. But what I have come to understand, come to believe in, have discovered is every company is different. Every life insurance company is different. All life insurance is priced, I get it, the same. The company has to put the premium to work. There's only so many bonds in the universe that they can buy. There's only so many pieces of real estate they can buy. And all of that, the actuarial, experience is the same for all of us. We all use the same actuarial, like the claims ratio, it's all the same, right? It's all equal. And the further out you go, it all varies to the center, right? Okay. What I have discovered and what I enjoy and what I deploy is understand the companies that we work with and their product by design. And then if I understand the client, what you're trying to do, what you want to do, it's like, oh my gosh, it's a match made in heaven. So does that answer your question?
It certainly addresses part of it. I want to say, though, that the idea that there is a specific, sole, only correct design does not come from Nelson Nash or becoming your own banker.
No.
That is an idea that you're getting, that other people have got, that originates from people who have used quote unquote banking and life insurance as a sales tool and a marketing gimmick, primarily on YouTube and on other podcast platforms.
Well, that's how because that's how the big wide world discovers it. But it's an outgrowth of noise, and it's not necessarily, not to be expected. Okay, I know whenever 15, 16 years ago, the goal is to have as much cash value as possible, as soon as possible, as much of the premium to go to possible, or to go to cash as possible once the death benefit has been solved for. And I don't care who you are or what you do. In my opinion, most of us have a need for death benefit in whatever variation that is. Right. And once the death benefit is solved for, which is prudent financial mechanics, financial planning, retirement planning, once the death benefit is solved for, then the focus is on cash value accumulation, which is going to happen in a dividend-paying life insurance anyway. The cash value is going to accumulate. So once you get past the need for death benefit, and then you're building a quote-unquote banking policy, Nelson said it many times. It is going to require so much death benefit you can't get it past the underwriter.
Right.
Right. Okay. I understand that we're trying to accumulate cash. So, the agent, the advisor who gets newly exposed to this, and they have one foot in the quote unquote financial world, rate of return. And then they solve, well, cash is king. And I believe cash is king. We start solving for cash. Well, then you squeeze down the base whole life premium, which is where the primary loss of liquidity comes from in the first couple of years of life insurance. And you solely focus on all cash in year 1 or 2, and then you compare it to cash. There's so many things wrong with that, most of which you can't see now, but you'll discover later. And it comes from a basis of either ignorance, right, or just trying to make something better than it is. I think Nelson Nash took life insurance and he didn't necessarily make it better than it was. He pointed out characteristics of life insurance that already existed that everyone else discounted, and this is a continuation of discounting the value of life insurance. Yeah. So I can go on, and I have many times.
Well, I like what Nelson says. If you know what's going on, you'll know what to do. And I think oftentimes people don't have a full awareness of what's going on, in the sense of how your need for capital and how the need to systematically accumulate and continually grow capital over your lifetime. I don't think that's taken into account, right? I don't think people are thinking long range. And so consequently, if we think in a more short-term fashion, where we're looking at what's going on in the first year or two, I tell, and I've told clients this week, that some cash value is better than none, some premium is better than none, a policy in force from a reputable whole life providing mutual insurance company is better than none, and that's fine, but, and so it's not that I'm saying, and that's why I compare it to fast food. You can go eat fast food. Is eating fast food better than starving? Sure. But is there a better way to live? In my view, yes, there is. And the illustrations and becoming your own banker and the way Nelson taught the infinite banking concept was not focusing on the first 2 to 4 years of a contract. He was looking at someone who's paying premiums over the course of their income generating lifetime and then enjoying some additional cash flow after, in his examples, the individual stopped working. Okay, that's a long range perspective. And so where I take it back to is, if you want to do what Nelson taught, then it has to come from becoming your own banker. It has to come from the book about it. And in that book, we're not, there is no specific only correct structure. The structure in Part 4 equipment financing is different than the structure in Part 5 and EVA distribution of age classes.
Which is different than CD sisters financing a car.
They're all different.
Which is different than the cost of a college education.
Yeah, and so this is what I tell people, you have to bring it back to the philosophy, and the cookie cutter fast food style never does, right? And so as soon as we want to if we're willing to rethink our thinking, like Nelson admonished us to do, and we consider the philosophy, why we're doing the infinite banking concept in the first place, and we start to think, well, if paying premium early on is good, and it is, so too is paying premium later on. Okay, so I might want the ability to pay a high premium for as long as I can. Okay, well, that's going to have implications for the structure, right? And I might, given that I want to as much as possible, to the best of my ability, accumulate capital and pay a high premium over the course of my lifetime, I want to challenge myself to do that. Well, I might also want the ability to where, if something happens and I'm not able to do that, to have the flexibility to lower my premium in a given year. So I want the ability to have I want a robust product, something that's going to accept a high premium if I have the ability and desire to pay it, but will also maintain its tax treatment and remain in force and all the good things if I choose not to pay that high premium. Okay. So flexibility. Well, if we think flexibility in addition to a long premium payment duration is of value, that too has implications for the structure, right? And the ultimate takeaway is, if the further and further you squeeze the base down closer to zero, the quicker you're going to have to scratch off these other values.
When you do that, you're not only the quicker you're going to have to, you are by default scratching off abilities in the future.
Yeah.
Period. And I said it before, there's at least 5 things that are deadly wrong with these really contorted policies, and you really do have to take a life insurance policy and contort the fire out. I spoke about this 6 or 7 years ago at the Nelson Nash Institute on stage, 400 agents and advisors, or 250 or 300, whatever, in the audience, and I'm talking about this, and I think that's really one of the only ones that has not, or one of 2 that has not been released in the big wide world, which it will be on the client only access on bankingwithlife.com. And I'm not trying to promote. I'm just trying to explain that there are a multitude of things wrong with policy structured that way, and you can't necessarily see it or understand it unless you know something about life insurance and how it acts over time, mm-hmm. right? And then of course it's over your lifetime. This idea that look, the average business person doesn't think beyond a year; they think in 12-month increments. I don't know why. It just is. The average all-American family, and which is not you listening, okay, the majority of Americans can't think past next week.
Right.
So this is not, short-term thinking is nothing new, but it's like Parkinson's law. We have to address it and deal with it, and you have to do it daily. All right. Okay. And when you say long range, Nelson said long range, and when you look at capital accumulation over your lifetime, your need for capital is not going to go away because you're getting 1 year closer to graduating. It is not going to happen. Go ask somebody that, I'm just saying, go ask how important cash, capital, money, wealth is to the individual who is getting ready to graduate. And everything that you accumulate on the face of this earth, what you don't spend and what you don't give away, is going to be left to someone else. Period. Go ask them. Do you want to leave your children, your legacy, your prodigy, whom you may never get to meet, do you want to leave them pennies? No. Who does? And if you do, we're probably not a good fit anyway.
Yeah.
Right? I mean, if you don't love your people, your family, or whatever causes you support to the point that you're willing to take action beyond talking about it, it probably can't help you. It's like, and it's okay.
That's
right?
fine. Yeah. It's
right.
just not a good fit.
And so while you're talking about long-term thinking, long-range thinking, and building capital over your lifetime does not mean you have to sacrifice the now. What Ryan's talking about is absolutely true, and it does not negate your need for capital now. Right? Nelson, in every one of his illustrations, and I've said it many times because Nelson said it many times, he would not put an illustration. If he rewrote that book before he graduated, he would not have put an illustration in there. Why? Because it's more of a hindrance. He's trying to convey a concept, right? And it's more of a hindrance because then everybody gets stuck on these life insurance illustrations. Then the financial guru, if they can't burn it down or take credit for creating it, then they got to take credit or try to make it better. Right. It's like, really? Okay. So not only can I build capital long range, and if it's built correctly, it's my choice whether I want to pay a premium or not. Mm-hmm. I'm not going to be forced to not pay a premium or be forced to pay a higher premium than I wish. So when I get back to handcrafted, custom, and if every one of your life insurance illustrations look the same, you financial advisor, agent, you're not, that's not personalized work.
Right.
It's like if you think 90-10 is it, or 80-20 is it, or 70-30 is it, what's customized about that?
Right.
It's like it's just another cookie cutting form. Okay. Nelson, in his illustrations, didn't finance anything until after he completed a capitalization phase. Well, look at equipment financing. Illustration number 1. Couldn't he have financed a truck in year 2? Mm. Yes. And if he did, all of the numbers on the right side of the page would have went up. All right. So my point that I want to emphasize here is just because we're building correctly to endure, to last into the unknown future, to serve the client well their whole lifetime, does not mean you're giving something up now. It does not mean you don't have any cash value in year 1. Right. It does not mean that you can't, control your capital flows or begin controlling the banking function in your life immediately. I rest my case.
Yeah, so nobody knows what exactly you guys mean by a well-designed policy. That's because you're not a client.
Preach.
If you were a client, you'd know exactly why the policy is built the way it is to suit your particular circumstances. And maybe this is the source of that frustration. It's like we're talking to cameras in a room here, right?
Not me. I'm talking to you on the other side of that camera. Thank you.
You'll get what I'm saying. Because
I'm slow.
Because the conversation isn't in terms of your numbers, because we're not talking about your income, your assets, your ability to pay premium at your age, considering your underwriting status. Since we can't have that conversation because this is a show, it's a podcast, then it's not going to be clear what exactly the structure is to suit your circumstances. And that should be the way it is for people who are not sitting 2 feet across from a client and telling that person what the right structure is for that nameless, faceless entity. That's the problem, right? That they assume that the right structure, that they already know the right structure by default before they meet you. That should be cause for concern.
Yeah, just tell me what premium you want to pay and I'll shoot you out an illustration.
Yeah. You know, it's like a home builder building you the custom home that you've always wanted before they ever met you.
Yeah, in a subdevelopment where every house looks the same.
Yeah,
except they're reversed.
Right.
Here's one's to the left, the other to the right. Yeah, custom.
Yeah, real custom. Yeah.
Well, listen, this commentator. She also said, she's like, James, what's up with the blue cup? It's girly. Get rid of it. And I'm like,
yeah, I had a Yeti one time. She didn't like the color of the cup. It's like, you know, my gosh, go to the audio version or something. You know,
I don't think your country even has a Bill of Rights. So I mean, there's a lot of countries that doesn't have a Bill of Rights. I mean, so the come and take it.
Yeah.
Milan Lebe. I'm just saying.
Well, and can you take time to actually show us examples of one? And you've mentioned it. You know, if Nelson had redone it, then there wouldn't have been.
Listen, I've got hours and hours of videos of real live illustrations out there. Oh my gosh!
And the examples are in the book. Yeah. Everything that's needed to understand what's going on inside of a life insurance contract is available in Becoming Your Own Banker. We can flesh certain things out. I have a way of putting things that's different than how other people put them, and maybe that's helpful, but at the end of the day, the source is Becoming Your Own Banker. That's where the examples are. If you find yourself feeling that need to see examples, go to Becoming Your Own Banker.
I like this one. This one was like, because you know, I'm human, right? And I'm unprepared. Mr. Griggs showed up with all the preparation, not me. And good job. I'm not disparaging preparation, all right? Look, she's commenting on a previous episode, and I'm not sure which one, but she says it is section 7702, not 7707. There is no such this as 707. Well, actually, there is a... Okay, let me continue. And it goes like this. 7702, the U.S. Internal Revenue Code. And I'm helping her out. I'm cleaning up the statement. I'm just telling. Okay, the tax code in 7702 defines what the federal government considers to be a legitimate life insurance contract and is used to determine how the proceeds are taxed. I don't give tax advice and I don't interpret the tax code. But she said that, you know, by the assumption here, it's section 7702, so she's correcting me, not 7707. So I'm like, I don't listen to our episodes typically. Every now and then I do. It's a self-critical thing. So I'm like, Andrew, did I misquote? Did I say 7707? And there is a 7707 tax code, but it just doesn't pertain to life insurance, okay? It pertains to a multiple of topics. And so Andrew goes through this whole episode, and he said, no, James, you said 770. And so in that episode, I said the 77 plan is a sales gimmick. Yeah. You know, and they're a flaky organization with flaky producers and editors, and, you know, they made a marketing scheme out of Nelson's work, The Infinite Banking Concept, and just lobbed off 2 out of the 7702 Internal Tax Revenue Code, and said, here we're going to market the 770 plan. So I just said in this episode, the 770 plan is a gimmick. And then she's like correcting me like I misspoke. And then Andrew goes through there. I did misspeak. And it's like, so quit it. I mean, so obviously a long weekend, she's drunk and turned into a keyboard warrior. I don't know. Yeah. And I'm Irish, so don't crack on me for drinking.
Well, here's another one.
Or referencing the drunk. I have a history of, you know, I'm Irish. I'm telling you, if it wasn't for alcohol, we would rule the world. The Irish. And then their big brother, the Scots, hampered them a little too. So.
All right, there's another point in here. Where does IUL, Index Universal Life, have a fallout with IBC? And I bring that up because I had another guy who had contacted the Nelson Nash Institute this past week, and with a similar question. The individual was a prospective agent. He was getting his license, and he thought he wanted to do both. He wanted to provide, I told you about this earlier in the week. He wanted to provide IUL contracts, Index Universal Life contracts, and he wanted the ability to provide dividend-paying whole life contracts to clients, and he wanted to get contracts with companies that would allow him to sell both of these types of products. And happily enough, he told me, he was frustrated when he told me this, but he said, the mutual companies that I'm talking to get a contract to provide whole life products, they ask me, do I intend to sell universal life or index universal life? And so the guy told him, yeah. He's like, I want to do both.
Yeah, whatever pays. I'm going to sell it all.
Right, the mutual companies wouldn't give him a contract then. And he was upset
insulted. What?
But I think that's a great.
Perfect.
Companies being discretionary about who they'll give contracts to. I mean,
about time.
That's awesome. Well, anyway, so why not IU? And then here's another level of it. The frustration of I can't find where my specific question is answered directly online, right? The idea is like I should have written an article talking about why index universal
or could
life.
You write an article? Could you write a 13-page email to answer my question? Because I have it, I'm going to obligate you and your time.
That is definitely the underlying mentality, and my position on that is like, could one do it? Could I go write that? Could we talk? Could we make a little thing about it? Sure, we could, but you could do that about any number of things pertaining to the world of life insurance or financial strategy, right? You can spend all the time you want on that. At the end of the day, as far as universal life is concerned, it's not a guaranteed product. Period. We spent a lot of time last time talking about how the cash value in a dividend-paying whole life contract is the net present value of a guaranteed future cash flow, right? The death benefit. That relationship, that actuarial relationship, is necessary in order to produce all the other beneficial elements about policy loans, about dividend payments, about control over the contract. That's a necessary relationship. Okay, it's not there in universal life, right? The underlying insurance vehicle in universal life is annually renewable term, which means that the future premium, as far as the cost per dollar of death benefit in the future, is not guaranteed.
No, it is guaranteed to go up.
Thank you. Yes, yep. There is an exponentially rising premium schedule that corresponds to the exponentially rising mortality cost in universal life, and that So you don't have any of the beneficial features. Over time, one of three or a combination thereof will happen. The premium per dollar of death benefit in a universal life contract will rise, right? So an individual will eventually pay more in premium. Or the cash account value. There is no cash value in universal life. There's a cash account value. That cash account value will begin to diminish in order to compensate for that rising cost of the death benefit.
What?
Or number three, or the death benefit will diminish. And what's more likely, if you hold that puppy out to maturity, out to the year of endowment, it'll be a combination. The premium will go up, the cash value will drain in order to offset the premium. Eventually, the cash account value will disappear, and because the premium is going to get so high.
Well, what about my tax-free income?
And so they'll start reducing the death benefit. And so you'll have universal life is a term replacement. That is all it is. If you get 30 years in, 20 years in, however old you are when you start, you're going to drop it because you're going to start to see what's going on in it. And I got a guy right now, great client, has indexed universal life, and we are exchanging the fire out of them. And
well, as you bring that up, it comes up over and over pretty consistently. This and other things, this IUL is just the latest version of universal life. And listen, universal life came out in the late 80s. E.F. Hutton, a stockbroker, organization to create a product to compete with, the life insurance industry and the financial gurus. But the bottom line is you really have, and then Ralph Nader, the consumer advocate, universal life is a quote-unquote unbundled product. You separate the death benefit from the side account that accumulates interest or earns interest. And oh my gosh, what were the interest rates in the 80s?
Right.
Oh my gosh. All right, well, they got it wrong there. All of those policies, if you've been in the life insurance business for 25 plus years, up to 40 years, what's happened to those universal life policies. And then So they got it wrong. The life insurance industry, forgetting their heritage, forgetting their history, forgetting who they are, and not knowing their product, dividend paying whole life. They acquiesced to all the outside pressure and Congress and the collusion, and they come up with these unbundled products. Universal
the history
life.
Of the industry.
Oh my gosh.
Capitulating to the pressure.
Yeah, and trying to, create the latest monstrosity of a product and forcing it on the unsuspecting American public. That's what, in my opinion, has gone on. They got it wrong. So they come out with VUL, variable universal life, in the 90s, right? Oh my gosh, the market only goes one way, right? Monstrosity can only go up. So we'll replace, and the interest rate went down too. We'll replace that side account that earns interest with the sub account like a mutual fund. And that's how you'll accumulate, the account values. Well, the markets don't go one way always. That didn't work out so well either. Oh, wait, and the cost of the death benefit goes up every year by the mere fact that your feet are still on the ground. Okay? All right. They got it wrong again. Strike two. So then they come out with the equity indexed universal life, right? And then they have to drop the word equity to get away from the risk of equities, right? And now it's indexed universal life. Same again, there's no risk, there's no loss, and it's couched in various ways, marketed in different ways that are less than straightforward and with less than clear promotions and explanation. I mean, I'm just saying that the lack of clarity is greatly used and abused in the financial world. Okay, and the life insurance industry is not squeaky clean. Okay. Mm-hmm. Anyway, they got it wrong again with the indexed universal life. There's no risk. No, the outside indices determine how much interest is paid at the end of the year. Right? It's a contract year.
Determines the gross crediting rate.
Yeah, the net premium. It's a gross crediting rate on the net premium. You bust open that 105-page life insurance contract or the 97-page illustration that it takes to illustrate universal life. All right, and you dang near got to be an attorney to read it because it's all in legalese. So I'm just saying there's zero. I can't go below zero. So if the markets are down, the indices are down, I didn't lose any money. Perfect. I didn't lose any money. Didn't gain anything, but the cost of the insurance went up too. Yeah. Oh my gosh, there's so many things
it's
that are
in the rising cost, and people. That's the immediate retort. Don't you know, James, that I'm guaranteed 0% on the
no loss.
Growth. Yeah.
Yeah. Well, why? Okay. Regularly, this week you mentioned speaking with a client this week. I as well. This particular week and the last week and the week before 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 and the week before. But large, well, it doesn't even really, the size doesn't even matter. But universal life, right? It's all created. It's a commodity in the industry. It's a commodity product. If you can create a better illustration than your competitor to get the consumer to say yes, then you win, right? Mm-hmm. And so that's completely an illustration, a ledger-based, an Excel spreadsheet type of sale, quote unquote. And every life insurance company knows this. All right, this is no secret within the industry at all. Okay, all right. So you have all of these universal life policies, and then they have all of these discounts. If you're super preferred, we're going to discount the cost of the death benefit, or we're going to table shave, right? Which means we're going to charge you less per thousand because we're going to assume or act like you're healthier than what you really are. Table shave. So if you qualified for standard, they'll give you a preferred just to get your business. And all of that matters on the illustration because all of that makes the illustration, all those numbers go up. And so lately, the conversation I've had with these clients, I'm like, listen, do you see here that you're super ultra preferred in your 50s? And you got to do your Fitbit and to continually qualify for this discount or table shave. I'm like, do you know how many people at your age are super uber ultra preferred? All right. And if it's true, right, and I hope so, you're going to outlive the statistically standard individual. right? Now you've got a universal life policy. The cost of the insurance is going to continually go up, and you can't do anything about it. And you sure have no control over the indices and the returns. The company retains all the control to raise and lower those. And when I spoke a minute ago about busting open that 100-page policy, go in there and look at the definitions of the charges. I've never seen so many esoteric names for charges. These companies make up names for the charges. They don't even exist. It's like, oh my gosh, did you dream about that in the boardroom? I mean, seriously. Okay, so if you're uber healthy and you're gonna outlive the average guy, and so you're gonna live to 90 or 95, it's dang near by default that policy is going to cannibalize itself, because you're not going to be willing to write the premium check required to keep it in force.
Yeah. And so it'll drain what is left of the side account or the cash account.
Well, you said it quite clearly a minute ago. There's one or two things or both that's going to happen. The death benefit must be reduced, and that'll be limited in your 100-page illustration and your 100-page life insurance policy contract, right?
Yeah. We can
I'm just saying this, like, they illustrate wonderfully. And when we get back to, this lady also comments on, the importance of an illustration. It tells you this and it tells you that. It tells you as if nothing changes. The numbers on the page, the premium that's illustrated, and that's all that is an illustrated premium, and it's an illustrated non-guaranteed dividend, and the accumulation, the increase in the cash value year over year, there is a guaranteed element to that, no question. And then the death benefit is not guaranteed because there's a non-guaranteed element, the dividend. So, yeah, illustrations matter to the point where, you can get some clarity on your particular premium numbers, on your particular cash flows. But in general, illustrations do not matter if you understand what's going on. Well, if you understand what's going on with the universal life insurance policy, then the illustrations won't matter. Right, because it'll not be good for you. The longer you live, the worse it's going to be. And it's by design. There's nothing that you can do about it. The problem, the flaw, is in design. Right? You can't correct that. It cannot be corrected. Right? Can it be managed? Yeah, sure. You can throw more premium. You can reduce the death benefit. But I was going to say earlier, the death benefit, you'll be limited on how much you can reduce the death benefit, because that's another sales tactic in the life insurance world. Oh, well, we're going to get up to the corridor, the least amount of death benefit for the most cash value, and then we're going to drop the death benefit in the future, and all these esoteric things that you're going to do to manipulate the illustration to get you to say yes and write a check. Right. And listen, I can go on and on. Look, I've asked the life insurance companies. I have yet to get an answer. I've got a general agreement that is true. The two most profitable life insurance products in an insurance company's portfolio. The two most profitable products in a life insurance company's portfolio that they want you to buy is term life insurance and universal life insurance. My question to them, that I haven't gotten an answer on, is which one is the most profitable?
Right.
And they don't know. I mean, you got to get to the actuaries. I mean, anyway, so if it's most profitable for them.
I don't know what a profit is.
Now, wait a minute. We have some actuaries. They do, but most don't. We're not talking about our actuaries, right? Our clients that are actuaries. And there's a shameless side plug. When an actuary or a Big Four accounting partner, when they buy life insurance, they call my office. I'm just saying.
Well, they can't. Well, I won't do it.
Okay, stop it. Be nice.
The Big Four loved Madoff, is all I'm saying. Yeah.
Well, not all of them. I mean, I'm just saying that's like the federal government. There are some federal employees that they understand what's going on.
They know what time it is, yeah.
They call our office too.
All right, what else does this one have here?
Well, here, I got one. I got one. Look, I love this.
Oh, yeah.
Why do you say the cash value grows tax deferred? Shouldn't it be tax free? Oh my gosh, if you're a life insurance agent, shouldn't you already know this question? Okay. No, I correctly stated, and because it's correct, is why I said cash value grows tax deferred. That's actually correct. Cash value grows tax deferred. And that's why I said it.
Yeah.
Is it accessible tax-free? Yes, it is.
Right.
I mean, I speak English. She reads and speaks English. I mean,
and the reason we say the reason it is tax deferred is that if you were to generate cash value inside of your contract in excess of your cost basis or the amount of premium you paid in since day one of the contract, and you were to then surrender that contract prior to your graduation, then the difference between the high cash surrender value and the premium that you paid in, that differential there is a taxable gain. And so at that point, you would have, from the time the contract originated to the time you surrendered, you would have deferred taxation on the inside buildup of the cash value in that contract. So technically speaking, the nature of cash value from a legal perspective, I'm not a lawyer, this isn't legal, I'm just someone who can read, that's all, right? The technical nature of cash value growth is that it's tax deferred. Now, can you borrow against the tax deferred growth using a tax-free instrument in the form of a policy loan? Yes, you can, right? So, square that away, however legalistic you want to be about it. The technical nature of cash value growth is that it's tax deferred, and you can get to it in a tax-free manner. So,
thank you. Look,
you can call that a banana, whatever you want to call it, is what it is. And it's not like we don't know the difference.
It's like, look, why do you say cash value grows tax deferred? Because it's true. And then comment, shouldn't it be tax free? Yes, it should. But the federal government has no restraint, right? And they create no profit, right? So the federal government doesn't know what a profit is. So, and they have no restraint on your property. All right. So should it be tax-free? Yes, of course it should be tax-free.
Everything should be tax-free.
Yeah. So, and why is it not? Is because your federal government, state government, local government, city, county, parish has no restraint. And oh my gosh, no kidding. Like that's a revelation, right? Yeah. The 10th Amendment, right? It's like an entity that can't, the federal government doesn't even have the ability to restrain itself. The state cannot. It does not have the ability to restrain itself. And by expansion, it needs your capital and your property. So, and I could go on and on about that, but I digress. I'll let my libertarian friends blow it up on that one.
I know nothing about finance. All right. So then the next,
I'm going to turn that volume up. I want everybody to hear that comment. Okay.
Another.
Look, this whole episode is turning into this one.
It's the Halloween episode. Frightening comments.
Well, then we should open it up. There's got to be more. Oh, there is another one.
Yep.
I think there's several.
Next one. Please explain what happens to the cash value if you take a loan and pay it back within a month. Does the cash value go back to the amount it was before the loan? All right, that's what she said. Now let me put some context around this, because I've had this happen with some companies. When a client logs into their little online account at the company, they'll see different things. They'll see something called a net death benefit. They'll see a death benefit. They might see cash value. They might see net cash value. Right? They see these different things, and the question's kind of getting at this right now, right? If you're an owner of a dividend-paying whole life contract, you have cash value. You exercise your contractual authority to collateralize part of the death benefit and take a policy loan from the life insurance company, and you've got a loan balance outstanding, and then you go onto your portal and you log in and you look at what let's say your death benefit is after you've taken out the loan. You might see that the number the company is showing you is a lower number, and you might think, wait, what's gone on? And this has been the accusation in committee meetings in the Senate and the U.S. Senate Finance Subcommittee on Debt and Tax Management, I think it's called, where they say that if someone takes out a policy loan, it reduces the death benefit. Okay, this demonstrates a lack of understanding of the nature of collateralization, right? We're not when you take a policy loan, in one sense, it is true that the net death benefit is reduced. But simultaneously, it is also true that the death benefit is not reduced. Right? So there's a difference between the death benefit and the net death benefit. When a company says, or a consumer advocate or some lawyer at the Government Accountability Office says that...
There's a Government Accountability Office?
Yeah.
Is it working?
It's like the...
I'm kidding. I don't
it's like different government names for things. It's the opposite of what it means.
Exactly.
And when they say that a policy loan reduces the quote-unquote death benefit, what they're saying is that if the individual who is insured on the contract passes away while there's a policy loan outstanding, then the death benefit that's paid will be reduced by the amount of the outstanding loan balance, including the interest charge, right? That's what is meant there. And so we might say that the death benefit net of a loan balance is smaller if you've got a loan balance outstanding. It's like, well, yeah, of course, that's the nature of subtraction. But so long as you're living, so long as the insured person on the contract has not passed away, the death benefit per se is not decreased by a loan balance. A portion of the death benefit is collateralized by the loan balance, but the only reason the loan could be outstanding is because the death benefit is what it is, right? And the only reason you can maintain the loan, the only reason you can carry the loan balance is because the death benefit has not gone down, right? If it came to a point where your loan balance exceeded the death benefit, or if the death benefit decreased to the point where it met or then went clear past the outstanding loan balance, then the policy would lapse. Right? And that's not, I mean, it theoretically can happen, especially if you contort the structure.
Oh, no, it can and will happen in the future for a lot of people who have...
think they got one thing and get another thing.
And embrace the infinite banking concept without any foundation in philosophy or economics.
Yeah. So I just want to be clear that
fundamental.
We're not taking loans from the cash value. That does not happen. Right? It's not even technically true that the cash value per se collateralizes the loan, right? Ultimately, what collateralizes a policy loan is the death benefit, right? If you don't repay if you as a policy owner don't repay a policy loan during the lifetime of the insured, whether that's you or somebody else, upon that person's graduation, it's not the cash value that will pay the loan balance, right? The cash value is just the net present value of the death benefit. Right? It's the death benefit that would ultimately pay an outstanding loan balance upon the death of the insured. Right? So we're not taking a policy loan from the cash value. When we take a policy loan, the death benefit isn't going down. The cash value isn't going down. Right? We have to start including these unhelpful, net this, net that kinds of things in order to square that kind of language away. But don't fall under if you did any research into the history of the taxation of life insurance, you start to see this, that people say, oh, you could, allegedly dividend paying whole life was on an unfair playing field with other assets because someone could pay a high premium, see the cash value shoot up clear past their cost basis, which happens if the policy is built correctly, and then the person takes a policy loan, and the accusation is that the individual got something for nothing on a tax-free basis. It's like, no, if the individual took a policy loan collateralized by a high death benefit, given that they had high cash value, then the trade-off is a lower death benefit, right? That's what they're giving up. It's not that they're getting something for nothing, but because life insurance companies capitulate to this unhelpful terminology, it's difficult to clarify the defense of what somebody might do. There's nothing wrong with, if you know what you're doing, you've been diligently practicing the infinite banking concept over your lifetime, you've built up substantial cash value, and you want to take cash flow on a tax-free basis via policy loan to fully or partially finance your lifestyle on purpose and to purposely run up some portion of an outstanding loan balance on the expectation that the eventual death benefit will clear it. You're the banker. You can choose to do that. There's nothing wrong with that per se. But we do it, you only get there after you understand that we're not taking loans from cash value, we're not reducing death benefit. So this, does the cash value go back to the amount it was before the loan? No, it never went down. Cash value is guaranteed. It's guaranteed to increase. It's the net present value of the death benefit. So long as the death benefit's promised to be paid and time is passing, cash value is guaranteed to increase. It's not going down, right?
Well, this, and I don't want to interrupt you, but that was a very lengthy explanation. But she goes on, she goes on in that question. And all of this is just a continuation of noise or misunderstanding. And maybe she's sincere, trying to get to clarity. But I have a hard time believing that when she questions the color of my mug and tries to correct me on something that I didn't say. All right. Also, how is interest calculated in such a scenario? And do you take the annual rate, divide it by 365, and then multiply it by 30? Please explain. No, I'm not going to explain a loan and how it works to you. Beyond, Mr. Griggs just did an outstanding job. But, you didn't get into the interest calculation, which is fine.
I can do that.
I know you can, and I could too, and I choose not to. But my point here is just the mere question. Right. It's clear that if life insurance is, just a gimmick and interest rates really matter, right? That's what this thinking is. Because, and if you buy into that, interest rates matter, and it's all about, HELOC and the velocity and get as much outstanding in a loan value as possible. And you get into that in the infinite banking world, should you have any residual cash values? Shouldn't all your cash values be collateralized? And it's no, hell no. Okay. But and if you buy into that, and I understand that, I understand cash flows and interest and that. My point is, whenever you're stuck in this idea that life insurance is all about interest rates, so therefore, we've got to use a universal life and we've got to go get the HELOC and create all this. Those, in the long term, in my opinion, are the policies that wind up lapsing or surrendering. All right, now, and going back to what you were saying and explaining, your basis, what you paid in premium, and that's not just a straightforward answer. Your basis changes with loans, okay, and premium. But you go forward, and whatever your basis is, let's say the basis is $100,000. All right, and you've got outstanding loans of, $200,000, however that happened. All right, and that policy lapses. You don't pay a premium, you surrender it. That difference, that $100,000 in my example, is taxable in that year of receipt. And it's considered the year of receipt when the policy lapses. All right. And it's taxed at ordinary income levels. All right. So this is not a game to abuse the life insurance contractual rights. It's not a game to pay a big high premium so you can have a big high outstanding loan and not address it. In the by and by, it'll all take care of itself, because you're using all these various illustrations as a sales tool to create these double-digit rates of return, and there's never a problem until there's a problem. That's just one example of why I say that. And I've seen these cases where people, they think they buy into the infinite banking concept, and they think they understand, and they think they have it with clarity, and they think an outstanding loan doesn't matter. An unmanaged loan does matter, right? And then I've seen lots of illustrations that, oh my gosh, you just go out. If you lived as long as Nelson did, Nelson graduated at age 88. I see a lot of illustrations within the industry that is embraced and promoted as this is a way to bank. Those are problems. There are going to be problems. There's like one illustration that comes to mind, a $965,000 tax liability at the guy's age 84, age 85. All right, now I don't mean to speak esoterically and all that. My clients know exactly who I'm talking about, what I'm talking about. Okay, so my point here is that just the way the question is answered, it is very common to get lost in the weeds of loans and interest rates. And it's look, at the end of the day, you're financing everything you purchase, period. You're either paying cash, right, or you're formally using a third-party lender's money. When you pay cash, you're never going to earn another dime of interest or have any control on that money that's spent. Yes, you get whatever the goods and services is that you did that exchange with. And on the third-party lender, you're never in control of that. It's just like the HELOC. The HELOC is another extension or example of noise, in my opinion. I'm not disparaging HELOCs. It's a financial tool if you want to use it. Knock yourself out. Do whatever you think and your advisors advise you to do. Okay, I'm not telling you to do it either way. But to take a HELOC and then to buy life insurance and then to leverage the life insurance to go buy, appreciating cash flowing assets in a turnkey real estate deal, it's like, my gosh, what are you really doing? And who's really profiting off of that? If I want to become my own banker and the first thing you want me to do is go be dependent upon a third-party lender, there's something philosophically wrong with the presenter, the whole scenario, and you and your thinking if you buy into that.
Yeah.
So,
Boom.
I'm just saying, another example of the noise.
Happy Halloween.
That was scary.
Halloween coming.
It makes me want some pumpkin pie, man. Listen, send me a pie. Don't send me these freaky questions. I'm fat for a reason, right? Because I like to eat. Okay. That was fun. I mean, look, I think it could be valuable too. We covered, like universal life, some loans, some thinking.
That was good.
Based on questions. Let us know if you like us commenting on unreleased comment or not. Okay. Thanks for listening.
Bye.
Thank you for joining us on the Banking with Life podcast. If you're watching on YouTube, make sure to like and subscribe and click on that little notification bell. Otherwise, join us on Apple Podcasts and Stitcher for weekly content.